Okay, let's get right to it. It is Thursday, January 29, 2026. If you've been watching the markets today, you definitely saw the reaction.
Oh, yeah.
Tractor Supply Company, ticker TSCO, they just released their Q4 2025 earnings, and the immediate response was, well, it was not good. The stock is down about 7.6% in extended trading.
It was a very swift reaction. And, if you just glance at the headlines, you might think the sky is falling over there.
Exactly. And that is our mission for this deep dive. We are not here to panic over a ticker symbol or just, stare at red numbers on a screen.
Right.
We're here to decode what this report actually tells us, because when you peel back the layers of this earnings call, and we've gone through the whole transcript with CEO Hal Lawton and CFO Kurt Barton, plus the slide deck,
Everything.
you get this fascinating look at the rural economy. You see exactly how the consumer is behaving right now, and honestly, you see the weird paradox of running a business that is completely at the mercy of the weather.
That really is the central tension here, isn't it? You have a company that, by most strategic measures, is doing everything right.
Everything. Gaining market share, modernizing.
They are. They're growing their customer base, and yet they still missed Wall Street expectations. So the question we have to answer is, how does that happen? How can you win on strategy and lose on the stock price in the same afternoon?
So let's start with the cold, hard numbers. We have the Q4 2025 press release right here. What does this scorecard actually look like?
Okay, let's ground ourselves in the raw data. Net sales came in at $3.90 billion. That's up 3.3% compared to this time last year.
Which on the surface sounds okay. I mean, 3.3% growth is still growth. It's not negative.
It is, but in retail, total sales can be a little misleading because that includes new stores they just opened.
Right. If you open 100 stores, your sales will go up no matter what.
Exactly. So the number that really matters, the one every analyst obsesses over, is comps, or comparable store sales. This just measures revenue from stores that have been open for at least a year. It tells you if your core business is actually selling more. And that number was positive 0.3%.
Positive.
Okay.
0.3%. So basically flat.
It is barely a pulse. I mean, it's a rounding error away from being zero. And because that top-line growth was so sluggish, it just trickled all the way down. Earnings per share, or EPS, came in at $0.43.
And the expectation was what?
The consensus, what Wall Street thought they'd do, was $0.46, so they missed by 3 cents.
And in this market, a 3-cent miss is more than enough to trigger a sell-off. But this is where it gets so interesting. Usually when a retailer misses, it's because, I don't know, they bought the wrong stuff or their marketing failed.
Management problem, yeah.
But reading through the transcript, the main reason here seems bizarre. It wasn't bad execution, it was good weather.
This is the aha moment of the entire report. It's this hurricane headwind. To understand Q4 of 2025, you have to remember Q4 of 2024. Do you remember Hurricanes Helene and Milton?
Vaguely, yeah. They were pretty late in the season, right?
Exactly. And for a company like Tractor Supply, a hurricane is a massive demand driver. When a storm hits, people rush out to buy generators, tarps, chainsaws, water pumps.
All the emergency stuff.
All of it. It's tragic for the communities, of course, but just from a business standpoint, it creates a huge spike in sales. Last year, they had that spike.
And this year?
Crickets. Silence. It was a historically quiet storm season. For the first time in a decade, no hurricanes made landfall in the continental U.S. during the quarter. So you're comparing a year with this massive emergency sales boost against a year with absolutely nothing.
So because nothing got destroyed, sales look terrible by comparison.
Precisely. Management actually put a number on it. They estimate that this lack of storms created a 100 basis point headwind to their comparable sales.
Okay, let's pause on basis points for a second. We hear that all the time.
Sure. A basis point is just 1/100%. So 100 basis points is a full 1%.
Got it.
They're saying their comp sales growth would have been 1.3% instead of 0.2% if the weather had just been normal with storms. It just highlights this crazy dynamic where, a disaster is a revenue stream and calm weather is a drag on growth.
That is a wild variable to try and manage. Your CEO can't just conjure up a hurricane. But it wasn't just the weather, was it? Because I'm looking at the breakdown of what people actually bought, and there's a very specific story emerging.
Oh, you are spot on. It's the classic needs versus wants narrative. Tractor Supply breaks their business down into a few buckets, but the most important one is CUE, consumable, usable, edible.
This is the whole grocery store for animals concept.
Exactly. This is the bedrock of the company. Livestock feed, equine supplies, poultry feed, wildlife food. These categories performed very, very strongly. If you own a horse or a coop full of chickens, you can't just stop feeding them because you're worried about the economy. That spend is non-negotiable. Your horse doesn't care what interest rates are doing. Your horse is hungry.
Right, the horse has to eat. But what about the other side of the store? The aisles with the stuff you don't actually need to survive.
And that is where the pain was. The discretionary categories, the big ticket items. We're talking toys, holiday decor, expensive clothes, power tools. All of those took a notable step down in Q4.
So the customer's walking in, they're pushing their cart to the back to get the 50-pound bag of chicken feed, but they're walking right past the cute $30 holiday ornament and the new DeWalt drill.
That is exactly the behavior. Customers are becoming incredibly selective. They are still spending to keep the farm running, keep the animals healthy, but the fun stuff is getting cut from the budget. It just signals a consumer who is feeling pinched.
And that leads us right into the profitability problem. Because if people aren't buying the high-margin fun stuff on their own, the store has to try and force them.
Which means one thing: discounts.
The dreaded promotional environment.
Yep. The report was very clear about this. December sales across the entire retail sector were softer than expected. So, to get people to open their wallets during Black Friday and Cyber Week, Tractor Supply and basically everybody else had to slash prices.
Which moves the product, but it just kills your margins.
It really does. While the promotions drove some volume, it got people to buy, it just ate into profits. Their gross margin actually declined 10 basis points in Q4. It wasn't a huge drop, but it shows they had to sacrifice profitability just to get sales to that flat 0.3% number.
And then on top of the discounts, they're dealing with inflation again. I saw a note about the average ticket going up, but not for a good reason.
Right. The average ticket did increase by 0.3%, but that was driven almost entirely by retail inflation. It's what we call price instead of traffic or basket size. They just had to pass on higher costs from commodities. And this is a big one: tariffs.
Tariffs. The other big macro headwind.
And it's not going away. Management was very open about this. They expect tariffs to continue being a factor through at least the first half of 2026. They're projecting about 20 to 30 basis points of pressure that they just have to absorb or pass on.
Okay, so if we stop right there, the picture looks a little gloomy.
It does.
No hurricanes, picky consumers, heavy discounting, tariff squeezing margins. It totally explains the stock drop. But, and this is a big but, when you turn the page to the strategic initiatives, it feels like we're reading about a completely different company.
This is why we do these deep dives. If you just look at the quarterly miss, you see a retailer that's struggling. But if you look at the strategic engine, you see a company that is aggressively future-proofing itself. The underlying engine is revving up, even if the car is stuck in a little traffic right now.
Let's talk about Chick Days. I honestly love that they call it retail theater. Sounds kind of ridiculous, but it works, doesn't it?
It really is theater. If you've ever worked into a Tractor Supply during Chick Days, you just know. You hear the peeping, you see the red glow from the heat lamps, kids are all gathered around the bins. It creates this emotional connection you just cannot get on Amazon.
Right.
You can't replicate the smell and sound of a live animal on a website, and they are doubling down on this.
How do you double down on baby chickens?
You make them available 365 days a year online. They're expanding the program significantly, but they aren't just selling the birds. They're focusing heavily on chick health and wellness. They see the chick as a gateway drug, if you will.
A gateway drug to farming.
Well, think about the lifetime value. If they can get you to buy 6 chicks for your backyard, you are now a customer for the next 8 to 10 years. You need a coop, you need warming lamps, you need starter feed, then layer feed, then treats. It just locks you into their ecosystem.
It's brilliant. You aren't just selling a product. You're selling a whole hobby and a lifestyle.
And that connects right to their huge garden center initiative. They have over 1,000 stores involved with garden centers now, whether it's a full build-out or just those pop-up tents in the parking lot. Live goods were a top-performing category, even in a tough quarter.
It fits that whole life out here theme. People are staying home, growing their own food. But the thing that really surprised me was the pivot to B2B. I always think of Tractor Supply as a place for the hobbyist.
The guy with 5 acres and a pony.
Exactly. But they're going after the big fish now.
This is the big barn strategy, and in my opinion, it is the most significant growth lever they have. They realized they were leaving a massive amount of money on the table. You've got municipalities, large-scale farmers, fencing contractors. These people buy in bulk.
But they're not going to walk into a retail store and push a cart around.
No way. So they started building a direct sales force. These are actual sales rep specialists who go out to the farms and job sites. They meet with farm managers, city planners.
That's a huge shift in business model. That's not retail. That's commercial supply.
It is. And look at the traction. They shared this one anecdote about their very first sales specialist to hit $1 million in sales in a single month. That was just this past December.
Wait, one person sold $1 million of stuff in a month?
In 1 month. It just gives you a sense of the scale here. They have about 50 of these specialists now, and the plan is to double that in 2026. It completely transforms them from just a shop down the road into a critical commercial partner.
But that brings up a logistics nightmare. If you sell 5,000 feet of fencing in a 500-pound safe, you can't exactly stick that in the mail.
And that's the other half of the equation. They're building out what they call final mile delivery. They're creating these specialized hubs at certain stores that act as mini distribution centers for all the big, bulky stuff.
So not every store has to carry the giant inventory.
Right. The hub holds the heavy stuff and services a whole cluster of surrounding stores. They're aiming for 375 of these hubs, which will cover over half their store base. And to actually drive the stuff to the customer, they are using a gig economy model.
Well, like an Uber for farm equipment.
Pretty much. Specifically, they mentioned integrating with a provider called Roadie. It allows them to flex their delivery capacity up and down without owning a massive fleet of trucks. It lowers the costs significantly.
That's a huge infrastructure upgrade. And speaking of infrastructure, we have to touch on pets. They bought this company, Alavet. How's that going?
It's going well. Alavet is an online pet pharmacy. It did about $100 million in sales in 2025. But the real play here isn't just the sales, it's the integration into the loyalty program.
The Neighbors Club.
Right. They want to embed pet prescriptions right into the Neighbors Club and the whole pet wash experience. Think about the share of wallet. If you're washing your dog there, buying your dog food there, and now getting your heartworm meds there,
You never have to go anywhere else.
you're totally locked in. It creates a walled garden.
And I have to ask about this because if it feels like every company does it, AI, is this just buzzword bingo or is it real?
In their case, it seems pretty practical. They expanded their relationship with OpenAI, but they're using it for forecasting and inventory flow. In a business that is so weather dependent, having AI help predict what stock needs to be where before a storm hits it's crucial.
It helps prevent the empty shelf problem.
The quickest way to lose a customer.
Okay, before we get to the 2026 forecast, there's one piece of financial wizardry they mentioned, the sale-leaseback. Can you explain that in plain English?
Sure, this is a very smart way to fund growth. So instead of just renting a store, Tractor Supply develops their own. They buy the land, they build the building. Because they control it, they save about 10% on costs.
Okay, so they get the building cheaper.
Right. But they don't want their cash tied up in owning buildings. They want to use that cash for inventory or AI or sales reps. So once the store is built, they sell the property to an investor and immediately lease it back.
So they get their cash back out to reinvest, but they keep control of the store.
Exactly. It's a capital-light model. It keeps their balance sheet flexible and lets them grow faster. It's very efficient financial engineering.
Okay, so that's the machine they've built. Now let's look at 2026. The CFO, Kurt Barton, he used a specific word, normalization. What does that mean for them?
It means they are hoping for a boring year. No more post-COVID spikes, no supply chain crises, and hopefully a return to typical weather patterns. Although, interestingly, he did note that Q1 2026 has already started with winter storm Fern, which actually drove some demand.
So the weather is already playing games in Q1.
Always. But normalization for them means getting back to a predictable rhythm. They're forecasting sales growth of 4 to 6% and comps of 1 to 3%, and they're planning to open about 100 new stores.
And what about this inflection point they keep talking about with margins?
This is the key takeaway for any investor listening. Management believes there's a magic number for their comp sales growth. It's in the low 2% range. Once they hit that, once comps are growing just a little bit more than 2%, their profit margins naturally start to expand.
That's operating leverage.
Exactly. Your fixed costs are covered, so every extra dollar of sales flows more directly to the bottom line. They're basically telling the market, if we can just get back to growing comps by 3%, we turn into a profit machine again.
So they're right on the cusp. They have the strategy, they have the tech, they just need the consumer and the weather to cooperate just a little bit.
They are betting the farm on it, literally. They believe the headwinds of the last couple of years were anomalies, not the new normal.
So bring it all together. What's the final take here?
Tractor Supply is a resilient beast. They missed Q4 expectations, yes, but why? Because hurricanes didn't hit? And because consumers cut back on Christmas ornaments? The core business, the feed, the medicine, the survival gear, that stuff is rock solid.
It sounds like they're managing the short-term pain while aggressively modernizing for the long term, bridging that gap between the old-school general store and like a modern tech company.
That's the perfect way to frame it. And I would leave you with one final thought to chew on. We are in an economy where consumers are clearly cutting back on toys. We saw that in the data. But they seem to be spending more on self-reliance, gardening, chickens, livestock.
Right. We see that shift happening everywhere.
So even if Wall Street panicked over one single quarterly miss, you have to ask yourself, is Tractor Supply actually the ultimate hedge against a recession? In a tough world, people might stop buying expensive toys for their kids, but they might start raising their own eggs.
That's a fascinating perspective. When times get tough, people don't go to the mall, they go to the garden center. Survival over luxury.
Exactly. And Tractor Supply is the only major retailer sitting squarely in that survival and self-reliance lane.
Well, spring is coming. Management said March is 40% of their Q1 sales, so the busy season is just around the corner. We will be watching to see if those chick days bring in the crowds. That's it for this deep dive. Thanks for listening, and stay curious.
See you next time.